People can see, that's fantastic. Technology checks out. And uh-oh, what? Write like a pro. Here's an easy way to blah, blah, blah. I don't care. All right. So, where are we? We're waiting for the Fed. That's coming up ahead. It's interesting because I was trying to get a write-up. What is this? I don't care about that. I was trying to get a write-up out of ChatGPT, which now has, I paid the money and I have the web browsing capability, but I tried to get the Federal Reserve, I tried to get him to do the Federal Reserve summaries, and he could not handle it. So see these plugins? That's what you get when you pay for it. You're able to access plugins. There's another cool thing on ChatGPT. I think it's on any version. See the settings in beta? I think only in the paid version, but the beta, you're supposed to be able to browse the web with Bing and enable plugins. So then, wait, let's see. Oh, I'm sorry. This is very important too. There are custom instructions. Okay. Now, you see how I have custom instructions already set? So I said, I'm PhilStockWorld, blah, blah, blah. My writing of style writing, address me as Phil, blah, blah, blah. So you can save all your basic information for your chats there. And especially useful if you like, you know, if you use them primarily for a main purpose. Mine's kind of generalized, but I use them for a lot of different things. But if you use them for a specific purpose that comes up all the time in your business, that's fantastic to be able to do that. We have Claude. We have Claude here too. Now Claude is different. I talked about that last week. Oh dear. Should be that, right? I hope it knows me that way. Log in. Please log in. Continue with login code. We just sent you a temporary login. Now, how about this? Continue with Google. Oh no, my daughter has completely screwed me out. All right, I gotta go to my other machine and check my mail now. Hang on. And of course, the email's not even open. Okay. A little concerned here. Why wouldn't it? Zero. Sign up. Oh, son of a bitch. Why would you be doing this to me? I'm over 18 and I agree to stuff. This is giving me like a brand new session. Wow. Before you get started, I don't know what happened. Chat not found. Start a new chat. This is scary to me. I hope I didn't lose all my Claude stuff. Maybe I signed in some different way that I'm not aware of. So message Claude. Well, anyway, so with Claude though, the thing is you load what I started doing with him is I send a letter from, I try to get a generalized idea of what's going on in the previous chat. I save it to Word document though, and I create a sort of a summary. It can read quite a long summary. So I created a scope of work of all the stuff that we've done in the past, as far as just, you know, this is how we do this, this is how we do that, this is how we do this. And that teaches him. So when you start a new thread where he doesn't remember what you did before, I say, hey, read this first and then let's talk. And he does that. And then all of a sudden he understands everything that we've been talking about before. That's very, very useful. I've tried that with Warren. It doesn't really work the same way because he doesn't remember things the same way as Claude does. But he tends to sort of carry over data from many, many conversations. And we've had hundreds, I would say, of different conversations. It's been a year, so it's a lot. Lots and lots and lots. Let's see how it keeps going. There's lots and lots and lots and lots of conversations about all sorts of things. Look, retail sales from March and April, the debt ceiling crisis, Hanes brand, banking business. But then, you know, that's only the title, and then it goes into all sorts of things from there. Learning Java programming, option spread adjustments. So, you know, I teach him all sorts of things when I can, and he learns. But anyway, so he has newfound web browsing abilities, and I said, can you give me a summary of what has happened in each of the Fed meetings of 2023 so far? I've done that. He supposedly can access the web. See this Mixerbox search? That's one of the plugins. So far, that seems to be the one that works best. It's, as far as I can tell, based on Google. So he's able to search the web and provide links and do other stuff that Bing can do. I think they just basically steal from each other. Yes, I want you to read and summarize. You do it faster than I do. That's the problem though. See, it's kind of googly. So he's using a Google reference, and that causes him to then, you know, just give you a response like Google would and say, here, read it yourself. That's really not what I've been using him for in the past. So here you go. Now we're getting somewhere. So this is from, okay. After holding rates steady, the Fed expects to raise perhaps twice during its 4 remaining sessions. Doesn't have 4 remaining sessions anymore. Fed is primarily concerned about stubbornly high inflation. The Fed will set rates on July, September, November, and December. The July meeting is primarily important. He's taking the article and just going from that date. Inflation, the Fed, but that's a problem. He doesn't know what day it is. I have to remember to put the date in because he doesn't know what day it is. He only reads articles and assumes that that's whatever is true. The Fed is walking a tightrope between controlling inflation, key events like OPEC production cuts and student loans. How aligned with the Fed's Okay, he's not like Bing. So Bing, in other words, is much more data aware. And with Bing, we can say Bing chat. Okay. Based on the Fed minutes from the 2023 meetings, what do you expect them to say this afternoon about the last meeting that might surprise investors? No, I can't call you. Stop. I have a webinar until 3. See, I'm multitasking. I can do phone stuff and the other. Okay. The committee has been concerned about persistent inflationary pressure and the risk of overheating. Some indicators and some indicators of inflation compensation have increased significantly. The committee has acknowledged the labor market has improved considerably with the unemployment rate falling to 3.8%. The committee has observed that the wage growth has picked up in labor force participation. The committee has indicated it is prepared to adjust the balance, blah, blah, blah. Wait, composition balance sheet reduction is holding treasuries, and the committee signaled it is likely to raise the target range of the Fed funds at a faster pace than now. Revised up median projection for the Fed funds rate to 2.1% at the end of 23. See, he's floating in old data. Yeah. I expect the Fed to say it's afternoon to 1.5 to 1. See, it falls apart. This is the problem. It's too much data for them to look at, and they fall apart. You have to get them specific things to look at. The more broad-based your questions are, the harder it is for them to figure out what they're going to say. Because they started out good. It's a good summary. It's good notes. But, and if you check out where his source is, well, that's vague, isn't it? But that's the problem then. So he's just looking at federalreserve.gov. No, here he is. He was looking at the April minutes. That's there. That one was the April minutes. This one was the general calendar for the year. So that's good too. Then he fell apart over here. He starts talking about, old stuff that he knows. And I think it's because the stuff that's loaded in the system, the things that are already loaded in the system, it is now October 11, 2023, based on recent Fed meetings and recent economic data. What do you think we'll see in this afternoon's minutes? You still think this is bad at 1.5%. Oh my God. That's the trick. See, it's very hard to get him on track. But anyway, so basically saying the same stuff, but it's like he's right about some parts of it, but then he's wrong about this basic fact, which makes it very hard to trust anything else he says. So then you got to check everything. So it's more like an advanced Google than it is a proper AI search. And unfortunately, putting this kind of stuff into ChatGPT for Warren doesn't help, because now he becomes as crazy as Bing, because it's too much. It's too much information, and he's loading too much, and there's only so many words they can comprehend at a time. And it's partially because the more things that you say to an AI, the more tangents it starts exploring. The more tangents it explores, the more it sort of drifts off into like just completely non-topical things. And then it's very hard for it to get back and reorganize itself. And again, and it's data overload. It's like just overflowing the memory. Because, if you think of your own memory, if I say to you, what's the Fed going to do today? Think about how many factors you start thinking about, trying to piece it all together. It's like, well, what's inflation been like? What's the Fed been like? What did they say last time? What's their action this time? Blah, blah. All that is like using up a huge amount of memory. And this is where we're better than AI, because it's a truncation issue. It's not, you think of all the branches, right? But what do? We quickly cut off branches. So we start thinking about stuff. Like if I say to you, who won the game last night? All right. Now, me saying this to you, me, actual Phil Davis saying this to you, people around the country, right? Each one of you is like, well, what game? There were lots of games last night. What game is Phil talking about? So then it depends on what knowledge you have. Okay, so in other words, if I say who won the game last night, and you say, well, Phil's a big Mets fan, so he likes the Mets, and that means he's probably talking about the Met game, given the season and all that. And there were no football games last night. It was Wednesday, it was Tuesday, so there wasn't a football game. I never hear Phil talk about basketball, so I doubt it's basketball. That's what I mean by truncating, right? So in other words, you start thinking about what makes sense. The problem is, for an AI, they don't have that. So they don't truncate. And that's a very human way to think. And it's important because you may have less total capacity than an AI system. But it's like a chess computer, right? A chess computer works by thinking about the next 1 million, 10 million, 100 million possible moves. And the more possible moves the computer can think of quickly, the better its answer is going to be. So what it does is it basically runs 1 million possible moves in its head. Not just the move you're at now, but obviously if I do this, then he can do that. And if he does that, then I can do that. So he's running the simulation for the game, maybe 5 moves further down the line, and quickly you get to 1 million possible calculations, or 1 billion, or whatever it is. It doesn't matter. I mean, the point is, he's running the game over and over and over again, like in war games, and that scene in War Games where he keeps running new simulations of nuclear things. A chess computer is like that, and these are language computers. He's running 1 billion possible responses, but the more variables you give him, the more possible responses there are, and you quickly overwhelm the system and get gobbledygook. In chess, there's a finite number of responses, but it's all about truncating, because it's a question of when do you stop along a poor line of reasoning. So, what's wrong with my car? Well, there's 400 parts, and there's thousands of things that could go wrong. So what's the more specific thing? The computer can think of all 1,000 things that could be wrong in your car, and it's going to ask you questions like, well, what do you think is wrong? What is it making a sound? Is it doing this? Is it doing that? And it narrows down and can eventually figure out what it is. And that's like playing 20 questions. So you have to think about the limits of the AI. But like I said, the problem is they don't truncate. So you want to give them step by step. I realized this when I was doing the reviews at PhilStockWorld, and in fact, I had this problem this weekend. Well, Claude was broken this weekend for whatever reason. But if we go to the main page on PhilStockWorld, I love that. That's funny. He might come back. I don't know if we can agree on anybody else. So here we are on the weekend. Nope, that wasn't the weekend. Here we are on the weekend. There's Claude hard at work. So Warren had to come in to save the day because Claude was not having any of it this weekend. He's done it before. He wrote this, he wrote Hello Humans, and he'd done the wrap up, but then I deleted the thing that something broke. Well, wait, what did it say? Oh, oh yes. Oh yeah, because I had done a lot of development work with Claude, and it used up his tokens. There wasn't anything really wrong with him. I should remember that because I was mad. I've been mad at him all week, and it's not really his fault. I was trying to teach him a whole bunch of stuff this weekend, and I overused my time. I used up all the possible tokens I could use, which is quite a generous amount with Claude, but I used it up because I was trying to teach him some really complicated crap. And so he timed out, and I had to wait, and I didn't want to wait because I was up early in the morning. So he had written this, and then he crashed out. So I gave it to Warren. But watch what happens with Warren. Warren goes, here's the summary. Key themes, this, that. Great. Trade ideas we had, great. That was all for Monday. Final thoughts, I added the chart. Tuesday, market conditions, key things, Phil's comments, community input, charts, final thoughts, very, very good. Then Wednesday, all of a sudden it's like Apple's earnings, gold, webinar. We did the webinar. He made a John Oliver corner, still okay. But then it's, as you notice, the theme though, it's getting more and more of like a summary with less and less good pulls. And that's the problem. The more he has to do, it starts overloading him, so he gets less and less responsive as it goes by. You know, and then this was an alternate shot I gave him to him. Oh no, I asked him to summarize the week on the whole, and he came up with this. And this is a very good summary actually. But that's the thing. I didn't make him break it down by days. I didn't ask him to pull quotes. See here, I had him break it down by days. I said, I want to see some quotes about what happened in chat. And what he wrote on Monday was fantastic. I mean, Phil delivered Phil delved into the art of portfolio construction, emphasizing the importance of balancing growth and value. As I said in the chat room, is discussing time horizons, blah, 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 political dysfunction in the market. It's a great thing, and he's pulling quotes and doing everything I want him to do. The problem with these AIs is you can't get them to do it consistently. It's really hard. So I have to go day by day. Claude has actually been better at that because I load up. When I set Claude up, I tell him what we're going to do. I can't do it right now because I don't have that thing. But with my proper Claude version over there at my other computer, you can set him up to do the work and give him a huge amount of instructions, like pages and pages of instructions in a Word article. I load that up and then he does it. Oh, and watch this. Okay, so if I go to the Fed, not this Fed, where's the actual Fed? So FOMC, because that's what this is about, FOMC meeting. Meeting calendar for information, right? Okay, so now Claude does not have web browsing ability, but he has the ability to consume a tremendous amount of information. So from the July meeting, I open up the minutes and I say, okay, let's just give him everything, doesn't matter. Okay, so I'm just gonna take all that, I'm gonna copy it, and none of the others can take this much information. Only Claude can. I take this. That was the minutes of the last meeting. Okay. But he doesn't unfortunately know what happened since the last meeting. The Fed is releasing minutes today, and we're trying to figure out what they are likely to say. Here are the minutes of the last meeting. So watch, I'm going to give him this, and I'm going to paste it. See how it comes out? It comes out like that. Paste text. You got to watch your numbers. If once you get around 200, he starts crapping out, but you can handle this, no problem. So I haven't, this is an untrained version of Claude. He hasn't learned anything from me yet, but he still has tremendous capabilities. It's a very, very smart AI. So based on the documents from the July meeting, discussion around inflation expectations, the minutes indicate inflation remained elevated in July, assessment of economic growth, risk assessment. In July, most still saw upside risk to inflation, though some noted emerging risks to downside growth. See the balance sheet. See if the balance of risks is viewed as more two-sided now. See, there you go. So this is good advice. Look for any shift in views in the state of the economy. Watch any updated views, policy outlook, balance sheet plans. Okay, so now I can tell him some more stuff. So now I can say September, right? Oh. Okay, because that's all they gave us in September, right? Oh no, that's not true. We have this. We have these materials also. Oh, so now I'm going to say to Claude, and this is how you do this stuff. It's very important to know. Since that meeting, they released this statement on September 20th. Pretty sure this one is too short. See, yeah, it's too short, so I put it in quotes. It's not going to make a blob entry like that. So now he's going to look at that, and now I'm going to say, and they release this data. And this is where Claude completely excels, because I'm going to open up this link of this insane amount of data. And he's going to read that too. But that's what you got to do. You have to build his knowledge base. So they now describe economic activity at a solid pace versus moderate. Previously, this suggests the economy is resilient. They know job gains have slowed but remain strong. Hiring labor demand may be moderating. Importantly, they keep rates unchanged after a series of hikes. The overall tone seems to suggest that they feel they're making progress and are less eager to hike aggressively. Okay. Here is the data that went with that last meeting. Whoop. This one should come out of the thing. See, it's a matter of length. So notice though, this is actually, it's good that it came out this way. I have not trained this Claude at all. He knows nothing about anything. I have had no conversations with him, but you just have to think of it as building a base. You know, he already knows everything. As of maybe 1 year ago, he knows every book that was ever written. Uh-oh, we couldn't connect to Claude. What the hell does that mean? Check your network connection and try again. That's weird. Or maybe it's too much data. Shouldn't be. Oh, because it's not the paid version. I have the paid version that holds a lot more stuff. See, that's what matters. The paid, you get 100,000 tokens per session with the see, and I didn't ask him for anything specific, so he's looking at the whole thing and thinking and thinking and thinking. There's only 100,000 tokens. That's compared to like 8,000 tokens on the other guys. But he's got 100,000 tokens in the free version and 500,000 tokens in the paid version, which is massive, massive, massive amount. But still can get crapped out. So now, September 22. Am I crazy? No, it's clearly, it was clearly from here. So they have a real hard time with dates. All right. Here's a few things I'll be looking for in today's minutes. Assessment of recent inflation trends. The September projections noted some tentative signs of inflation pressure abating, but core inflation remained elevated. I'll look for any updated views based on the latest data. In September, they characterized the labor market as remaining tight, but with early signs of demand and supply. I'll watch for changing the assessment risk to outlook. So he's saying this is fantastic, right? Look for updated views based on the latest data for assessment of inflation trends. And we just got the PPI report. So, I mean, I don't want to bore you guys, but I mean, you can keep going, give them the PPI report and do all kinds of stuff. Risk to the outlook, September risk to inflation was seen as weighted to the upside, and I'll look for whether more risks are balanced, and with rates changes, they'll look for any new guidance. Now, you know, we're going to get a lot of stuff in these minutes, so we'll see what happens. So he's ready now. He's completely ready for the next, for the Fed thing that comes out, and so are we. So that's good. So meanwhile, all right, let's get back to good old PhilStockWorld. Oh, take a look at the markets while we're at it. Ew. All right, so everything went down a bit. So that PPI report was not taken very well, which is what I talked about in the morning. The dollar is pumping back up. It kind of hit 105.50, and it's heading back up. It jumped up a half a point since then. So that obviously hurt. Oil took a bash, right? Was 86, now back to 80, back to 84 something. Natural gas really got hit hard, but now it's bouncing back a bit. It's all crazy. It's like it's not exactly predictable at the moment, which is why we're kind of hanging out and just watching what happens. See if there's any questions. No questions. I am amazing. I cover all the bases. I cover all the bases and I explain everything perfectly. That's how I choose to interpret the fact that there are no questions. Anyway, okay. Let's get a little deeper into this. You guys got, you know, we talked about the chart, but what you got to know about the chart is we're still in our 4,000 baseline chart. So the 4,000 baseline chart, 20% up is 4,800, 20% down is 3,400. No, it's not. It's 3,200. Why is that? Obviously, 20% down would be 800 down. It should be 3,200. Does that make all these lines wrong, or is it just this line is wrong? Just this line is wrong, I think. Oh, you know why? See the compression? It's I forget what they call that, like an algorithmic chart or something. Anyway, so it compresses as it keeps going, so it can encompass, you know, much higher amounts. That's not a good way to do a chart, though. I don't like it. I wonder if I can turn that off. But anyway, so yeah, these are wider out, and therefore I put the wrong number. It should be here, but that would, I think maybe I might have even done it on purpose because it just gives you kind of a warped view. And I try to make it the same amount, but it's not the same amount anyway. 1, 2, 3, 4, 5 boxes, and this should be 5 boxes. Well, it would be, right? 32 is 5 boxes. I have to fix that. It doesn't change the lines. The lines are math, so it doesn't change where the lines are. But from 48 to 4 is 800, and therefore your bounces from 800 are going to be 160 points. But I think we calculated this drop. We only fell from 46 to we didn't even hit 42. So that would be 400. This is 4320. Let me see something, 160. Yeah, so I don't think I'm making it less confusing, am I? All right, here's the concept for the 5% rule. We have a 20% band that the S&P is going in. This is long-term band on a weekly chart. This is weekly, not daily. So this is over several years. we have a 20% range. We haven't really been in the bottom of the range, right? We left that in the dust. But still, we haven't proven the top of the range either. So the baseline is still 4,000 because we have not proven we can break over 4,800. Therefore, the baseline is still 4,000 until we're shown something better. We had at this point, at this point in the year, as the market started going up and up, we started giving it the benefit of the doubt. We redrew the chart with 4,400 being the baseline. And we said, well, let's say we're locked in the top of our range. And that's all it is. I was saying we were going to be locked in the higher end of our range, and therefore we could draw a new chart that had a 10% plus and minus from 4,400. But that really hasn't proven out. We haven't gotten past, we haven't made it 10, we didn't make a 10% top because 4,000 plus 10% is 4,000, no, I'm sorry. 4,400, sorry, 4,400 plus 10% is 4,640, not 46. So we never really made it over the range, and then we fell right back down below 4,400. So we're back to using our 4,000 baseline charts, which is scary because that allows for a massive 10% drop. It's still a very strong possibility. Oh, and let's talk about that for a second. So in other words, we had to switch back to the lower charts because the higher charts, the more aggressive charts, were not being proven out by the indexes. Here's where you are. This is RSI, the relative strength indicator. This is overbought and this is oversold. That's a really reliable channel with RSI. It very rarely breaks out of those channels. And I'm talking about like 100-year history kind of things. It almost never goes too high, it almost never goes too low, and it'll always tend to head back towards the middle. So we had this, obviously very long period of being really peaky on RSI. We went back to an oversold here, okay, which gives you a good idea that we should be in this chart still, that there's no reason to be panicky. We're still in the strong end of the chart, but now we quickly go back to overbought, and we're just as overbought now as we were when we were at 4,800. That's weakening. So in other words, at 4,800, we were RSI here, and then at 4,600, we're higher than we were when we were at 4,800. That's not good. We have less relative strength at 46 than we had at 48. That means the overall strength of the market is weakening. It's just as if you like lifting weights, and back here, you could do 300 pounds, 20 reps, and then you get over here and you say, well, we're doing 300 pounds, but only 14 reps. That's less relative strength than you had before. You have weakened. The support of the market has weakened. That's how you think about it. Then we have the MACD line. That gives you these are the strong moving average. Now you see what happens here. Well, these things don't tend, once you start declining, once you have this death cross on the MACD indicator, right, on the short term comes over the long term, like we have here, kind of, right, like down here it starts, and then it gets worse, okay? These things don't tend to turn around for no reason. So you can be in for a pretty long decline until we get back down and form a base. We are nowhere near forming a base, so that's very scary. This can fall apart. You don't get a lot of air saves. We did get, like here, you see how we were heading down and it got saved. That's what's happening right now. See, there's a little saving action going on. This is coming back up, and hopefully we'll get a pop back, but that pop back can very quickly lead to just more destruction. It's only a pause in the downturn, basically. But the key line here, the 4320 line, is super, super key. And unfortunately, I think we're back below it. 43.46. No, we're not below it yet. We're still at 43.46. So you got to watch that very, very carefully. And the futures are, and these are for the end of the year now, it's for December 31st. The futures are 30 points higher than where we actually are. That's a pretty big gap. It's almost 1%. So there's a lot of room for being disappointed in these charts. And today I wanted to focus on discussing, well, first of all, the most important thing is that the entire S&P, and that goes to the NASDAQ too. It's the same stocks, Apple, Microsoft, these are all NASDAQ stocks. So the entire S&P and the entire NASDAQ is being pushed by these 7 and really 8, because Google is counted twice, stocks. Google has GOOG and GOGL, and both of them carry weight in the index, even though the company itself, it's ridiculous. Anyway, it's very stupid the way they do it. But the S&P and the NASDAQ both have the same problem. They have two Googles, one company, same earnings, same revenue, counted twice. And then we have this batch. We have Tesla, who have been accused multiple times of cooking their books. That's another problem. And then we have NVIDIA, who's a fluke. It has nothing to do with the economy or any reality of any other kind. It's like, well, I mean, NVIDIA is, and it could last, because it's like Apple was at one time. It's like Microsoft was at one time. Microsoft invented a software way back, right? That was adopted and used on almost every single computer in the world. And they became a huge, phenomenal, wealthy company. And for many years, they drove the NASDAQ and they drove the S&P. They just grew and grew and grew. Now, will that happen with NVIDIA? Probably not, because, chip companies only have such and such a lead until other people catch up. NVIDIA just happened to be at the right place at the right time, because they were developing these chips to take advantage of gaming and augmented reality and virtual reality that they felt was going to be the next niche for them. So they started developing these very, very smart, fast chips that when AI came around, all the AI companies said, you know what? The best chip for us is going to be these gaming chips. And they all started basing their AI on the gaming chip technology that NVIDIA was developing. But it was just luck for them. It wasn't their plan. And but they also quickly pivoted to make themselves very much an AI chip maker, because they said, well, this is the future. Screw these gaming people. Gaming people won't pay $5,000 for a chip, but the tech companies will, especially when you're buying thousands of chips at a time. So NVIDIA is just benefiting from being in the right place at the right time. How long that'll last, we don't know. These are nothing wrong with these companies, except that you're basing the whole story of the S&P and how well it's doing, and stocks are up 11% this year, which we talk about down here and look further down the article. When you say that, that includes these 7 companies. Without these 7 companies, stocks are up 4% at best for the year. And that's not even that is ridiculous, because these companies are being pulled by the 7 main companies. Apple pulls all of its suppliers wherever it goes. Amazon pulls a lot of stuff along with it also. Companies it does business with, so on and so forth. Tesla's got their part suppliers and the people they work with. Microsoft, of course, has contracts with all these different companies and cloud services and so on and so forth. They have a very, very broad pull effect, and it causes a huge amount of overvaluation. But meanwhile, if you take out those 7 companies, the S&P is trading at 16 times earnings, which makes it fair. Usually 16 times earnings is fine. I don't mind paying that. That's pretty much the historical average earnings. I eject when it gets over. But you still wonder how much of that is based on the fact that just a few companies are doing really well and the rest are just barely, keeping themselves straight. So that's what we talked about this morning. And we really have to see with earnings what's going on. But I mean, dangerous. And I pointed out, well, again, I pointed all the stuff out in the article. The prime rate has gone from 3.25% because we were 0. It's generally 3% over the Fed. So the Fed was at, until right here, until last year, at the end of last year, the Fed fund rate was 0.25%. Oh, and now it's 5%. So it's like, or it's over 5%. It's almost 5.5%. So now the Fed funds rate is up at 8.5. So it's more than double in just over a year. That's crazy. When's the last time we had to do that? Almost did that here after 2000, right? And we had a big batch here. We had a huge jump over here in the 70s. This is when Nixon took us off the gold standard. That was a huge deal. And so that caused interest to fly up because the dollar was no longer backed by gold, and everything calmed down again. Although calming down meant that. Then we had inflation. But that's what this looks like. This looks like this. It does not look like, it doesn't look like we're going to come back like well, nothing looks like that, right? You could say it looks like this, but this only ended in more inflation. You know, we did come back, but then it was a disaster afterwards. And then the 80s started, and that, look at this. This is 12% in like 1978. And it's still 12% in 1982 and 3. And look at that. That's recession. That's a 2-year-long recession. It's a 1-year recession, some recovery, 2-year recession. Higher than 12%. We're only at 8.5% right now. This could easily keep going. Nobody is prepared for this. Nobody's expecting this. Nobody's looking at this stuff. And I'll tell you right now that when rates are 12, 13, 14%, okay, people are not going to lock them in. You guys are not going to lock the rates in. You guys are going to say, well, what if they go higher? And then they will go higher. They'll go to 16. They can go to 18. They were 21.5%. That's Greece. That's where Greece's rates were. I mean, that's really awful. And see, that's why I'm always an inflation hawk, because this is when I lived. This is when I graduated high school in 1981. So to me, this is like what I remember when I was first going out, and we would get we try to borrow money, and our student loans were like 12% and things like that. It was crazy. Everything was crazy. You couldn't buying a house was like, how are you going to buy a house and pay 20% interest on the mortgage? It's just, I mean, that's just what you had to deal with. It's like buying a house. That's never going to happen. But we survived. We got through it somehow. But the point is, when rates are 14, 16%, you guys are still not going to lock it in, because you're going to be saying, oh, no, it might go higher, and then I'm going to be screwed with this terrible interest rate or whatever. I mean, I'm talking about like saving money at those rates. So when you have a chance to buy a 30-year bond for 18%, and you turn it down, that's like that's better than the market returns are. It'd be unbelievable if the market returns could match that for 30 years. Never obviously happened at all. And you can just become a wealthy person by just putting the freaking money in a bond. I know when I was that age, that's why everybody would give you bonds for presents, because the value, the front value of the bond, they would only, they'd give you, and these people were cheap. They would give you like $100 savings bond. They would only be paying, because it's a 30-year bond, they would only pay like $14, $15 for the $100 bond, because the interest would take care of the rest. So they put in an envelope when you're having a birthday party or a bar mitzvah or whatever, they would figure in an envelope like a bond that has a 12% coupon, but they would only put in like this tiny little amount and give you a $100 bond. I remember I got a $500 bond once, and I was like, I'm going to cash this in and get a bike. And I was like, I went to find out about cashing it in. It was literally like $60-something. It was so stupid. I was so angry. Anyway, so everything's relative. That's the thing. Now, here's corporate debt that's rolling over. The reason it hasn't been a big deal on the earnings report is because this is all it's been so far. But next year, it's much, much higher. And the year after that, it's higher. And it's going to continue to be a tremendous amount of debt that rolls over. And these are all rolling over from 3.5% loans to 8.5% loans, or whatever they end up being. That's doubling the amount of interest that these companies are paying for their debt, and companies are massively, massively in debt. Each one, these are trillions. 1 trillion, 2 trillion, 3 trillion, 4 trillion, $5 trillion. Most corporate debt is generally 5 years, 10 years kind of debt. So, you know, these are all still there. All these issues are still there. This is a good chart on the Rule of 72. So yeah, historically from 1928 to 2022, so before the Great Depression, including the Great Depression, up to last year, the S&P has averaged 11.5%, including dividends. Okay, so it definitely is more like 8.5 without the dividends, but with dividends, it's 11.5%. So that means you don't take your dividends, you put them back into the market each year. T-bills, 3.3%, real estate, 4.4% return, bonds, 5%, gold, 6.5%, corporate bonds, 7%. So right now, corporate bonds being 8.5, that's higher, could go to 9.5 or 10. It starts going to, once it goes to 9, this is not very attractive because there's risk in the S&P. There's theoretically not as much risk in corporate bonds, and especially when T-bills start paying 5-6%. Which are theoretically risk-free. Oh, here's 10% annual returns. Yeah. So yeah, this is 30 years, right? This is what I'm talking about with the bonds. So they're giving you a $160 bond. How much they put in? $10,000. So or $10 is 160. That basically was why people used to give bonds all the time for gifts. Then the PPI came in at 0.5%. That's too much. That's inflationary. That's right. Well, that's the Fed minutes around now. Anyway, so then that brings us up to where we are now, which is looking at what the Fed's doing. And I imagine that they didn't say much. Okay, so now we have the new minutes. Watch how interesting this can get now. So here's we changed that, and over here, boom, see, comes out. Now we have the HTML for the Fed. Okay. And now we get to say to Claude, okay, here are the new Fed minutes from the September 20 meeting to meeting. Now you can compare them and give us your notes on what has actually changed, what it means for investors, and what we can expect from the next Fed meeting and why. That's all I expect out of you. Control V, and it comes out as big, it comes out as a thing again. So, well, it's on tape, so you'll see it. If you follow the steps that we're doing here, with, let's say, the background of a company and the annual reports of a company that you want to check out, and you just follow these questions. Once you load it up, you can ask it anything about, what do you think of the investing? What do you think of this thing? You can feed it articles from various sources so it can then digest that and have a sort of an overview of a company. It can be an incredible analytical tool for you because you can feed it all of the data and just step by step by step. You have to build it logically so it makes sense. You can't just like throw data at it. But if you get it to think in a logical order, you will get phenomenal responses out of these things. So based on September and July Fed minutes, here's the key changes and takeaways. Economic assessment. Upgraded view of economic activity, solid pace versus moderate in July indicates resilience. Job gains have slowed but remain strong, suggests some demand moderation. Still supply demand imbalance in the labor market. Inflation, continue to note inflation remains elevated, though it has moderated somewhat. Emphasize the need for more evidence. Inflation is on a sustainable downward path. See, now this is very important, right? Emphasize the need for more evidence that inflation is on a sustainable downward path. Do we have that evidence? Majority see likely need for one more rate hike, though some see rates as high enough. Shows a divide. Focus shifting on rate hikes for how long to hold restrictive level. Balance sheet reduction will continue and likely for some time even after rate cuts start. Key takeaways. Economic resilience allows them to hold rates steady for now. Still concerned about the high inflation. Policy outlook remains data dependent. Messaging that rates will be held for some time, even like overall minutes point to the Fed ready to continue tightening at a more gradual pace. They are looking for more definitive signs of demand cooling and inflation easing before declaring victory. Patience seems to be the emphasis for now. So that's great analysis, right? Really well done. Now, what data or information would you like me to get so that you can make a reasonable prediction for the upcoming Fed meeting on October, I think it's, I don't know what it is. It's well, it is November, 31st. It is Halloween. That's weird. Okay. On October 31 / November 1. Because he can't see the web. That's the only problem with Claude, is he can't see the web. If he could see the web, it would be great. But on the other hand, maybe not, though, because he would be confused like Claude is. I'm sorry, not like Claude, like Warren is. Because Warren, now that he can see the web, has too much to think about, and he's more limited than Claude as far as how much he can think of at one time. Oh, God. So, but he's telling you what he wants. That's great. So, now watch this. Then we take this and we go to, I don't think Bing can even do this job, but let's see if, I think it's too much for, it's going to be too much for Warren too, though. That's the problem. How much crap was in here? Not much. Okay. Okay. So, Claude has been analyzing the Fed data and would like the following information updated as of, did that happen? As of October 11th, 2023. Oop. Did I quote the right one in the beginning? No. You gotta make sure you put stuff in quotes properly and whatever, right? So I'll be very curious how this works out. It's a lot of requests. So realistically, I probably should be doing like one bit at a time so that it can figure it out. So I should go recent inflation data, this and that. But let's see what he does first. If he gets screwed up though, I may have to just like kill this session and start again. So he's doing it section by section. He keeps going back to use Mixerbox. That's how he's accessing the web. But we're asking him to hold a lot of data. So let's see what he comes up with. Oh, he's doing a good job. Look at this. That doesn't sound right. The unemployment doesn't sound right, does it? No, he's got totally wrong information. Damn, that's a shame. And that's a big problem with AIs too. They can give you like really good looking information, but it's wrong. And if we didn't know it was wrong because we pay attention to this stuff, that's the problem with the whole internet now, is it's full of dumb, wrong information because people don't filter and they just put stuff out. It's really kind of scary. Okay, so that's out. Let's see if Bing can be more helpful. Too many things for him. That's all there is to it though. So now we're going to go to Bing. And we're going to say whatever it is Claude said. So we go to Bing. I don't, there are, let's just tell him Claude AI needs up to date October 11, 2023 data to analyze the latest Fed statement. Here are his requests. Oops. Okay, and here are responses from Bing for your requests. Now it's going to end up being a little tedious, so we'll see how it goes. Let's make this smaller. There we go. See, and again, only Claude can handle this much data. Anybody else freak out. I mean, Warren couldn't even handle the question. And neither can Bing, though. I know Bing for a fact. Bing has a 4,000 character limit to stop you from even doing this kind of thing, but to overload it. Look at this shit. Wow, dude. Median CPI 4.1 from 4.2, and we can always open it up and check to make sure he's on track and using the right stuff. Consumer Price Index 2023, blah de blah. Very good. Okay, shit, that's good. Okay, so then we go copy and paste. Oh, good, it's pasting little things. This is going to be much easier. Control C, Control V. So you guys think I'm like being lazy when I do these AI things, right? I got to do all this shit just to put a report together. But I got to tell you, I mean, don't just think about this. This is why I think it's really important, okay? Because don't just think about this as what we're doing here, but think about how this will apply to your businesses or your friends or your family. I've helped people do ad campaigns. I've helped people put together business plans. I've helped people, do efficiency reports. You can teach it almost anything. You can teach it how you like things done. And like I said, once you teach it, you can save it into a file. And especially with Claude, you can drop the file to start your session. And then he's like, oh yeah, okay, I remember all that stuff we talked about. Now let's go. Let's, what do we do now? Let's hit it. So, okay. These are the employment numbers, 330. That's the right number. See, I knew that other one was wrong. Okay, I'll go there. And GDP growth. Isn't this crazy though? They're like two AIs talking to each other. If we can only get them to actually, go back and forth, then it can be done properly. Then we wouldn't have to spend all this time. But that's the thing. Once when you play with them and you get to learn what their capabilities are, then you have to say, okay, well, I know the limitation of this one. I know the limitation of that one. I know the strengths of this and the strengths of that. And you start using them together. And we talked about the GDP growth. The IMF global GDP path was not very encouraging. The US is essentially an outlier on the whole planet at the moment, where our GDP is not projected to be recessionary, but almost everybody else is. This is unbelievable amounts of data we're getting here. I mean, I can't process all this, and I'm pretty freaking good at it. I mean, GDP growth, 4.9% higher than 2.1% in the second quarter. The advanced estimate for GDP will be released on October 26th. Retail sales, food and services, adjusted for inflation, blah, blah. He's got hard numbers here, everything. August 23 above August 22, retail sales, consumer spending, blah, 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 blah. I mean, this is freaking great. I hope I don't want to overload them here. That's what I'm a little concerned about as we keep going, but this is really, I'm freaking, I hope you guys enjoy it, but I'm freaking fascinated by this. This is unbelievable. Let's see if any questions. Okay, you're just talking about gold. I'll get to that after this. See, he's keeping the thread together, right? I didn't give him a good question here. It just says regional Fed surveys can provide, which is all he said. But he was, he's talking about one thing. He's still on track. He understands what we're asking for. Look at this. Philly Fed outlook showed that manufacturing region declined overall with indicators The Richmond Fed showed manufacturing activity improved. The New York Fed expanded modestly in September. The Kansas City Fed, wow. Go Bing, he's gotten way better. Bing used to be my dumbass of the group, and he's really coming up. We never even gave Bing a name. Oh, no, we did. We call him Shellbot. That's right. Bing is Shellbot. And the reason he's called Shellbot is because when you ask him a question, he tends to like go off on these huge rants. But in this case, it's great. It's like super thorough. Uh-oh. Are we done? You don't get the things until he's done for copying. There it is. Look how his answers are basically the same every time, size-wise. Jesus. Housing indicators. I mean, I know he can read this much as far as the total amounts. I just don't know if he can read that many different ones at once. If you paste too much, though, this thing will go dark and you won't be able to click on it. This is amazing. Now, meanwhile, shit, this is not my regular Claude AI. I was going to say, meanwhile, I've got this incredible amount of data for the quarter that we can chop up and analyze 100 different ways. But the problem is I don't, because this isn't my normal Claude. I'm going to have to move this data over. That's going to be a whole nother pain in the ass thing. And also, by the way, I understand I'm doing this for free. I just signed up for free for this account, and this is a kind of computing power I'm getting. I could send a guy to the moon. You could really ask like all the instructions to build your own rocket ship and go to the moon. Doing this for free, just to sign up for an account and just start asking questions. Be like, how do I do this? Where do I get those materials? What do we, how do we build the computer systems? How do we communicate? Just ask it whatever you need to do whatever you want to do. And Bing is doing fantastically. I mean, this is some amazing stuff. Still not hitting the limit. What was that? That was housing market. Now we do consumer confidence sentiment. That's a big topic. Thank you for your interest in consumer spending. Okay, he's got the dot plot. We can skip that. He's got the minutes. All right, so just give him this one last thing. So we'll do the Fed speak. And it's good that he caught that was important too. Holy crap. So he's explaining it first, which he knows, which is kind of a waste, but decline for the second cycle, lower than market expectations, the present situation rose, blah, blah, blah. Expectations, consumers more consumer prices, especially for groceries. CSI lowered by 1.4. This was slightly higher than expectations. Consumer expectations decreased. CPI, blah, blah. See, we saw all this stuff. We just don't remember it, do we? We went over all these things as they happened. These data suggest, I would never say that. These data suggest that consumer confidence sentiment weakened slightly in September as consumers faced higher inflation. Okay, great. I'm going to ask him what he thinks to see who gets a better report in the end. Copy that. Wow. Oh, wait, did that not paste? Oh, I think we're at our limit. 5 is the most you can have. I never tried it before. Oh, wait, no. Did I not copy this properly? Copied? Nope, that's his limit. So a lot of crap to process. Inflation shows signs of moderating, but well above the target rate. This supports the case for another hike, but doesn't necessitate an aggressive move. Job growth remains solid. The wage growth is cooled. This suggests demand moderation. GDP rebounded. Underlying seems resilient. The housing market is clearly cooling with declines in sales and prices, but supply remains tight and prices elevated. Overall data indicates the economy is transitioning to a slower pace of growth and inflation is coming down gradually, but persistent labor shortages and services. Inflation means risk remain tilted, not titled, to the upside. Markets expect another 50 to 75 points in November. No, they don't. Wow. Wow. That's interesting. I don't think the markets suspect that. The Fed speaker minutes will help gauge if these official. Okay, so now it's time to. Okay, so let's get him back to reality for a minute. Fed speak. Okay. Here are consumer confidence and Fed speak. I think you have the rest from previous direct Fed inputs above. So here's that one I couldn't paste before. And now we have to ask the final question for Claude, which is Fed speak. Be interesting. Now I can play this differently with Bing as a test. So I'm going to say, given what we talked about here, I'm then going to ask him to tell me how he compares the current Fed meeting to the last one. Saying, here's some examples. I'm a little concerned about sort of like cherry picking. But of course, how could you possibly go over every speech when they do 11 speeches a week? This is good though. I mean, Jerome Powell had a conference. He said this. Vice Chair Jefferson, of course, obviously is significant. Then Lori Logan said this. Bostic said, and we know what Bostic is going to be dovish. He said he favored holding rate steady. Daley said she wants another hike. So you see, this is looking at the work that goes into it when I'm like, when I pop into chat and I'm like, oh, here you go. And you guys are like, oh, he's so lazy. Just let the AI do the analysis. This is what it takes. But still better than me sitting there for 2 hours reading stuff until my eyes are bleeding. All right. So there we go. Here's consumer confidence and Fed speak. I think you. Okay. to give us a comprehensive outlook on what we can expect at the next Fed meeting and why. I always want to know why he says something. Okay, so given all of the above and comparing today's, it was October 11th, 2023, Fed minutes to the last one or two sets of minutes. What do you think is the most likely action to be taken by the Fed at their October 31/November 1 it's a meeting, right? Yeah, the November meeting and why. Okay, so now we're going to give Bing a chance to do the same thing that ChatGPT is doing. So based on the data provided here, recent data shows inflation is moderating but still elevated, especially core services, excluding housing jobs data. Strong tentative signs of cooling demand, GDP rebounded, but consumer spending is mixed. Fed speak indicates growing debate on need for further hikes. Some like Bostic advocating for pause, while others like Daly still see the need for risk outlook becomes more balanced, but inflation remains concern primary. Baseline expectations is for another 50. Where does he get this 50-point hike? Bringing cumulative tightening. Six with 400 basis points. Minutes and forecast below percent was my target, frankly. So I mean, I don't need further dot forecast, but moderating tone and data dependent, so sluggish. Slowing points ahead, 25% increments or pause is possible. Balance sheet reduction to continue. Upcoming CPI is critical. Watch the wage growth in the October jobs report. Fiscal policy is uncertain with debt ceiling shutdown poses risk threat. Financial conditions are restrictive. Blah blah blah. Okay, you are out of messages. See, that's what happens. That was too much thinking. Still, that's what you do. I mean, that's what you construct a report. Oh, subscribe to Pro. Of course, that's because it doesn't know I'm a subscriber. Now, Bing, for no money, says, based on the comparisons of the Fed minutes from August and September, I think the most likely action to be taken by the Fed is to hold the benchmark rate steady. Here is some reasons why I think so. The Fed minutes from September showed that most of the Fed officials were uncertain and cautious about the economic outlook and wanted to move carefully. They noted the risks of tightening too much versus tightening too little have become more two-sided and that they needed to balance between become entrenched. So what's he basing that on? That's interesting. Okay. That's based on an article that says basically what she just said. What he just said. Continue reading. See, the thing is, now this is the problem, because when you read it, this is Market Watch. I mean, you have to think about how good the source is also, whether it's worth believing that. The Fed minutes from August showed that most Fed officials expected one more hike this year, but some expressed doubts. The economic data released since September meeting have been mixed. Non-farm payrolls, the financial market conditions have been volatile. The political uncertainty has increased. All right, so given this, we can copy this still. I fed that data into Claude AI, and he thinks the Fed will go up 0.5%. I'm interested to hear why you feel Claude's analysis is based on the assumption the Fed will follow its previous guidance and projections, which indicated one more hike in the year and higher rates in 2024 and 25. However, I think the Fed will revise its guidance and projections downward based on the latest data, which show the economy is facing significant headwinds and uncertainties, and that the inflation is likely to moderate in coming months. Claude's analysis does not take into account recent Fed speak, which shows a growing debate of the divergence among the Fed officials and the need for further tightening. Some Fed officials, such as Bostic, yeah, no shit, Jefferson, Logan, and Powell, have expressed doubts or concerns about the impact of higher rates on growth and stability. They have suggested the Fed should be patient and data dependent and avoid prematurely or unnecessarily tightening policy. These officials note may vote against or dissent from another hike in November. Claude's analysis also ignores financial market conditions, which have been volatile and restrictive in recent weeks. The stock market has been hitting new highs, but hasn't been hitting new highs, so I'm not sure what he's talking about. But the bond market has been signaling lower growth and inflation expectations. The dollar has been strengthening, but oil prices have been rising. These factors could affect consumer and business confidence. The Fed may want to avoid adding more stress. Claude's analysis also overlooks the political uncertainty, which has increased in recent days, the possibility of government shutdown looming, and the ongoing labor market strikes. These factors could have negative impacts on consumer business confidence. The Fed may want to wait for more clarity. Therefore, I think the Fed will adopt a wait and see approach in the next meeting and keep interest rates unchanged to have more clarity and confidence about the economics. However, they may also signal the role to adjust stance if the data warrant it, and well, they always do that, and maintain stability. Interesting, right? So he definitely disagrees. And then from that, I'm supposed to figure out what to actually say to people, but that's fine. I don't mind that. That's my job. All right. So that was fun. So now we know all about the Fed. We know more about the Fed than you probably wanted to know. Here we are at 2:30. But that's pretty wild. So the market reaction, meanwhile, is positive. The market gets the impression that the Fed is also, so the market kind of agrees with Bing that they're not looking to do a rate hike. Whereas Claude says economically they have to do a rate hike. I think 0.25%. I'm going to stick with my guns on that one. And that takes us right about to that takes us to 5.75%, which is almost exactly where I said they'd have to be before they paused anyway. Not pause, but stop. You know, pausing doesn't count. So very interesting. So what is the question that our friend Andrew has? Could you comment on gold? It seems there is far less interest compared to the past. I would have thought it would move on war news. Maybe it's just become an industrial commodity like copper. Well, gold has moved. So here's one thing, is you got to think about gold. And let's go monthly. Okay, so gold has moved a lot. Since 2018, it was $1,200, and now it's $1,800. That's 50%. Gold is consolidating for a breakout to $2,400, but it could take years. Here's gold in 2008. And look at this consolidation from 2006 until 2007. So a year and a half consolidation to get from 600, because we went from 400 up 50% to 600, then a 2-year pause. Then finally it moves up to 1,000. It's a really impressive move, too impressive, and it pulls back and it comes again. So essentially here, we're now consolidating. Remember, 50% move, consolidate. 50% move to 900 and consolidate for 2 years, right? A 50% move from 900 is what, 1,350? Watch what happens. It goes 1350, it goes higher, but what does it essentially do? It consolidates for 1, 2, 3, 4, 5, 6, 7, 8, 9, like 9 years at 1350, consolidating for the next move up. 50% move up from 1400 really is where it paused, and effectively stopped, is another 7, and that's to what? To 2100. So what are we doing now? We're consolidating under 2100 or 2000, or really 2000 is a more logical one, but we're consolidating over many years for a move up. So, you have to take the bigger picture into account. Gold is not going to revalue itself more than 50% and then keep going. It's going to take the better part of a decade for gold to establish itself at that level to the point where it's ready for the new move up. And what causes that? What causes a move up? It's not just a war, therefore gold goes up 10% or something like that. It's got to be something massive. Now, recently, gold came back this year because Russia invaded Ukraine. This is what gold is. Okay, so this is Russia invading Ukraine and tons of people putting money in instability. Palestine throwing a few rockets at Israel, obviously it's horrific and blah, blah, blah. But in reality, compared to what's going on in Ukraine, this is nothing. This is two small neighboring countries going to war versus Russia and Ukraine, which is a huge thing. So yeah, oh yeah, sure, Palestine fired a couple of thousand rockets and overwhelmed the Iron Dome. Good luck resupplying. They've been planning this thing for years. Israel puts in the Iron Dome, and the Palestinians stockpile rockets because they've been told by their partners, whether it's Iran or Russia or both or whatever, they've been told the weakness in the Iron Dome is only has so many rockets. Okay, just and in case you don't know, the Iron Dome is the conceptual defense against missile attacks, that you've got these super fast missiles, and when an incoming missile is detected, they launch and intercept and blow that missile up in the air. It works fantastically. But the only thing that doesn't work is if you've got 1,000 incoming missiles, and you've only got 500 missiles in your Iron Dome launcher, right? Before you have to reload or resupply or whatever, then they're not all going to get hit at the same time. So a rapid, massive attack against an Iron Dome system has now been proven to be effective. And how do you fix that? Well, you install multiple redundant Iron Domes, makes it a very expensive proposition. That's the thing. All these military technologies and all that, you gotta come up against a budget. In fact, that's what Russia's problem is with the Ukraine. They've got all these tanks and bombs and equipment and all kinds of stuff, but Ukraine is causing them to lose it at a very rapid rate that is bankrupting their country. It's great to have a huge giant army, and Russia did this in Afghanistan too, many decades ago. It was the same problem. They've got all the weapons, they've got all the troops, but if you're going to make it expensive for them to keep coming with their weapons and their troops, then it's a problem. And the thing about any big country with this kind of war is you don't want to necessarily, obviously Hamas hasn't seemed to care with Israel, but you don't want to be, and neither does Israel care, frankly, for Hamas. When they're coming back and attacking, they're being very aggressive also and not being careful. The U.S. is generally very careful about not blowing up a school and not blowing up a hospital and so on and so forth. Russia, everybody misses. So accidentally blowing up schools, accidentally blowing up hospitals, yeah. Russia is not quite as careful as we are. Ukraine is generally very tightly targeting Russians. But it's spread over a much bigger amount of land and so on and so forth. So, for Russia, for Hamas to advance on Israel, they have to advance 1.5 miles, and they're in the middle of Israel. for Russia to advance on the Ukraine, they've got to drive tanks 1,000 miles, and they've got to drive 300 miles into Ukraine before they're anywhere. And all that whole 300 miles along the way, we have all these cool ways to blow up tanks. And then they don't have tank support, and then you're fighting, then the Russians are fighting an embedded Ukrainian army who have positions and so on and so forth. It's like D-Day, right? You know, we went to, you know, we had to attack D-Day. It's beaches in France. It shouldn't seem to be a big deal when you have an overwhelming force, but it is a big deal because the enemies are already entrenched. They have positions, they've got bunkers, they've got bullets, they've got everything set up, and they're waiting for you to just dare to get in their sights. And that's why it's a horrible, you know, watch the beginning of Saving Private Ryan. It's a horrible, awful, terrible battle just to take a beach. That's what the Russians are doing. They're trying to take a country, and it's very big, and there's Ukrainians everywhere. And that's also, you have to think about that also. When the Americans took the beaches at Normandy and everything, they opened it up. There weren't Russians. I mean, there weren't Germans everywhere in France. You know, that once they got past the beach and the fortifications, it really was a pretty good march to run the Germans out of the country. That's not the case in the Ukraine. You kill the Ukrainians here, there's a whole nother batch in the next town waiting for you there. And eventually Russia runs out of troops, they run out of tanks and so on and so forth. It is hard to fight a modern war because it's very easy, not very easy, but it's fairly easy to disable a $50 million tank with a $100,000 bomb. And that's a problem. That's an economic problem. You know, and obviously, you know, the physics are involved. You know, tanks got to be able to move. It's got to be able to move an effective amount of distance on an effective amount of fuel and so on and so forth. So you can't just say build bigger tanks, build stronger tanks. That's not the solution. So, and without the tanks, then you're just basically doing what we do in Afghanistan, which is driving around with SUVs and hoping that nobody put a mine in the road. And that's no good either. So, you know, and believe me, I'm not poor Russia, but you got to realize how horrific this kind of war is. I mean, you're just putting people into a meat grinder when you try to take land the way Russia is. And Hamas isn't trying to take land, but the thing is that by, look, Israel has always had this fenced-in policy, and one of the reasons is there's terrorism from the Palestinians. Hamas is one of their terror groups, and you know, Israel had been fighting it by fencing it in and allowing the Palestinian people to have autonomy. But now they're saying that, well, now it's going to get reevaluated. They're going to be like, wow, this is a mistake. This whole two-state thing could be a huge mistake, because who wants somebody who can do this to be at your doorstep? How do you live in peace when attacks are launched from the block next to you? You know, it's like if New Jersey attacked New York, and you know, and even then, at least there's a river between New Jersey and New York. There's rivers and bridges. Israel doesn't have that. They got a fence. That's all they got between Israel and Gaza, and it's going to be bad. It is bad. I mean, I think they're marching in now. Israel's marching in now into Gaza, and they're going to occupy it, and they're going to occupy it, and they're going to search every building, and they're going to search every house, and they're going to question every single person. Also, the whole thing is stupid. I mean, who attacks a country where every single person in Israel has been trained in the army? It's mandatory. They have mandatory army service for every single person in the country. So they can mobilize a shit ton of people very quickly. And that's what they've done. They just called in 300,000 troops, you know, from home. Like said, okay, you 300,000 people out of, I think they got maybe, I don't know how many people in Israel. How many people are in Israel? This should not be such a hard question. 9 million. Wow, it's more than I thought. I thought 6 million. Okay, that's why this is why we check. So they got 9 million people, and figure half of them are not fit for active duty. So what they've done is of the population that's fit for active duty, so too young, too old, right? So figure of 4.5 million people that are fit for active duty, they just call down 300,000 people. They've all been trained. Every single person in Israel has been in the army for a couple of years. They've all gotten training. They are all ready to rock and roll. They just called them in and said, report for duty, get your uniforms, get your guns, blah, 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 and they're all ready to go. That's why attacking them is like insane for Hamas, because they're just going to take over the country. Their retaliation is going to be horrific. Well, they got 150,000 new people last year. That's pretty good growth. Wait, Israel's population grew by, what does that mean? The current population of Israel is 9 million. Israel's population grew by 150,000 and now stands at 3 million. That's completely contradictory. Anyway, so big mess. Big mess over there. So gold. Anyway, so that war is nothing compared to the Ukraine war, and gold has already gone up from the Ukraine war. That's what we were talking about, was the gold. You know, gold is not a demand metal due to the price. It would be a demand metal because it's an incredible conductor, and it is used in iPhones and things like that because there's nothing better than gold for conductivity. So there's a little bit of gold in like every iPhone. But it's not a demand metal because everybody chooses something else. I'm sure you guys have all seen stereo wiring that's gold plated, and again, great conductor. I use gold cables myself on my stereo stuff. It's not that much because it's only electroplated gold, but even electroplated gold increases the conductivity tremendously. So still, it's exotic. It's an exotic metal for industrial use. They generally will go with alternatives. So there's not the kind of steady demand that puts a floor on the silver. It's more of just a question of a flight to safety of currency. And, you know, gold is very easily traded, universally, blah, blah, blah. And by the way, though, it's interesting because since 9/11, which is back here, gold used to have the advantage of being easy to carry around. I mean, not easy to carry, easy to transfer and easy to transport also, that you would just take your gold on an airplane. You can't do that anymore. Everything is, you know, there's all sorts of laws now that prevent you from carrying large amounts of anything that's valuable. And they x-ray every single bag and check every single thing. It used to be people would, you know, have their pockets filled with diamonds and their pockets filled with gold coins, and that's how money would move around. That made it much more valuable. You know, my grandfather always had some gold coins because he was, you know, he was a Jew who lived through all the persecutions and stuff, and he always had gold in the safe. He had gold coins in the safe, so just in case, in his mind, in case, you know, the shit hits the fan and you got to take off and run out of the country, you can always grab your gold coins, and that's something you can count on. So that's where we are in gold anyway. So I mean, I think we're consolidating below the 2000 line. It could be, I think it's going to be soon. I think this is, you know, again, this is what, 4 years of consolidation. I think we're at the point where we can start counting on going up, but we'll eventually go up. And I think you get a lot more bang for your buck from GOLD. If I can find my chart things. Nope. None of these things are my charts. Okay. Anyway, so Barrick Gold. I would rather own the gold miner than own gold, because basically you've got a leverage play on the price of gold. So Barrick is ridiculous down at 15. It's down a lot more than gold is, and it makes no sense because Barrick was you know, Barrick was 17, 18 back here. So why are they 15 now? This is a great price for Barrick Gold. It's a fantastic time to get in because when you do it, they are, and again, I love to check my facts. What are the proven reserves of Barrick Gold, GOLD, and what is their true value based on all you know about their operations and why? So I think about 70 million ounces of gold. So then if we look up on Stockopedia, GOLD, so this is $26 billion. It's a PE of 13. They're making $2 billion a year, right? Not, you know, next year forward PE. They don't have a lot of debt. $800 million, $867 million in debt is not terrible. When you're making $2 billion a year, it's really not a big deal at all. And they've had good growth. The profit of the company goes up and down based on the price of gold. But again, they've made much more money. They've got a lot of mining expenses and so on and so forth, but they've made much more money on the same amount of sales in prior years. So their expenses are climbing. But they're projecting, you know, here they made $4 billion this year. Probably they sold some mines or something. You know, you got to assume that's something special happened there. Something unspecial happened in 2018. But generally, they're good for a couple of $1 billion a year. You're buying them for $26 billion, so it's 13 times earnings. And you can do options with that and make it a very interesting trade. And Bing says 76 million ounces of gold. So you think about that, 76 million ounces of gold. 76 million ounces of gold times $2,000 is $152 billion worth of gold. But of course, it's in the ground. They got to get it out. And so whatever their extraction cost is what you have to worry about. And I wonder if he's going to mention it here. That's why we call it shell bot. It just keeps going and going and going. Oh, and copper. Yeah, and also 12 billion pounds of copper. That's 76 million ounces of gold, 12 billion pounds of copper, and that's $3 a pound. So that's 36 billion there. The true value of these reserves, it's $152 billion worth of gold in the ground. The question is, what are they going to take it out for? Copper was 432 pounds, then the gross value of Barrick's reserves about $134 billion. Because I said 2,000, which is higher than what they're calculating with. He's using 1760.50. However, gross value does not account for the cost and risk involved in extracting. See, very good. Look at it. Okay, so all in sustaining cost for gold production, $894 per ounce. So what is the value of Barrick is the difference between 1760 per ounce minus 894 is 866. So that is their cost of gold. This includes the cash cost of operating, sustaining capital expenditures. By the way, very impressive, right? This is everything I would have said about Barrick too. Costs include cash operating costs, sustaining capital expenditures, exploration, blah, blah, blah. Costs of mining, closure costs, taxes. Therefore, the net value of Barrick's gold reserves, so I had to do this, deducting the AISC was about $66 billion, and the net value of its copper reserves was $21 billion. You can buy the whole company for $26 billion. This doesn't, but however, this does not account for the time value of money, right? Because they can only extract 5 billion ounces a year, 5 million ounces of gold a year. So if they produce 5 million ounces a year, it's going to take them a lot, 16 years to pull that gold out of the ground, 15, 16 years to pull the gold out of the ground. Meanwhile, if you buy the whole company, in other words, to get to that gold, it's going to take you 15 years to get it all out of the ground of their current reserves. Meanwhile, you could have done something better with your money. You're paying 26. So 866 was our net profit, right? Times 5 million is $4 billion. Then minus their operation costs and so on and so forth. So basically, and they don't sell their gold at the wholesale, at the retail price. They sell it for wholesale to refiners and people, because they've got the raw gold and it still needs to be turned into something usable. So they're making their $2 billion a year, but you're paying 26 billion. So your return is 113. That's your capitalization. It's good. It's a nice rate of return, but it'll take you what, 7 years? 7 years? 7 years? Yeah, basically it's going to take you 7 years to recoup your investment. That's the bottom line. Doesn't matter how much they got on the ground, but as a long-term investor, it does matter because I'm going to keep making that money. So if you want to have gold long-term, I'd rather invest in Barrick, who's going to make money on the gold that they have, right? While you're waiting for gold to go up, because you just buy gold, it's a lump that sits in your safe or whatever, wherever you put it. So if you buy gold, you've got a rock. But if you buy Barrick, you've got a company that has more rocks than you're ever going to buy. They have 76, or I'm sorry, whatever number billions, $150 billion worth of gold, plus another God knows what worth of copper. They've got all that, plus they are using it to make $2 billion a year back on your 26 billion. So they're making 10% a year back while you wait, and as the price of gold goes up, their margins increase and they make much, much more money, assuming that it stays ahead of their extraction costs. So to me, I would much rather have Barrick. It's almost like buying gold and having a 10% dividend on the gold, but it's also massive leverage because their costs don't change that much. So if the price of gold went up $400, which is not very much, 20%, it would increase their margin by 50%. And then the stock would go well up, and you'd still own all that gold, and you still get all those dividends. And again, not dividends, but return on your investment, whatever you want to call it. The discount rate can vary, the overall costs, according to Finance Barracks, WACC, the weighted average cost of capital, 6.72. Therefore, using this discount rate, we can estimate that the present value of Barrick's gold is 49 billion and the present value of copper is 16 billion. That's fine. That's a heavily discounted rate, still taking you to double. I mean, it's 50, $65 billion, almost triple where they are now. Environmental, social, regulatory risks. Wow, he's being vicious. Blah, blah, blah. Using Barrick's enterprise value ratio, blah, blah, blah. Using the reserve valuation, we can estimate the adjusted value of Barrick's reserves is 390 billion. The adjusted copper is 127. However, adjusted value is not necessarily equal to capitalization. This implies that either Barrick's reserves are undervalued by the market or there are other factors that reduce value beyond reserves. Some possible reasons: the market may have different expectations, assumptions about Barrick's future performance. The market may have different perception or preferences about Barrick's risk profile, and the market may be influenced by other external factors such as Barrick's share price. The problem is the market tends not to really see gold the way a gold miner, the way I do. I see it as a storehouse for gold. And I'm sorry, that's not fair because there aren't many companies as good as Barrick. Barrick has the lowest cost of extraction of any gold miner. They relentlessly, they buy other gold companies. They buy small gold companies who have 8 mines because they want 2 mines. Because they have 2 mines that Barrick wants, because their cost of extraction hits their target level. And also Barrick, when they come in there, they're experts. They can actually do a better job than most small miners. So they buy a junior miner who has 8 mines. They take 2 of them and put them in their portfolio. They sell the other 6. And they don't even care if they basically break even on it. But what they now have is they have a portfolio with 2 brand new mines that have fantastic extraction costs. So That's why I think, because when you buy gold, gold is worth what gold is worth right now, right? But when you buy Barrick, Barrick is totally undervalued, doesn't take into account the gold and copper holdings that they have, doesn't take into account their operating profitability. I like that. I think gold is a fantastic bargain. And let's round this out since we're finishing the day right here. And you go to gold, I think, hopefully, all products. So we go to GOLD. And Barrick doesn't pay a big dividend, so I would not worry about the dividend. Oh, it does go out to 2026 now, so you got 2-year look on it. Barrick's at $15. You can pick up the $10 calls for $6. So what does that mean? That means it's not even 6. It's a 6. Oh, it's more than 6. 610. So say 610. So you're buying the calls for 610. Barrick's at 15.13. So you're paying a net 16.10 here. So you're paying a $1 premium to own it out here. So all I have to do to erase the premium is sell a call for $1. So I could sell the 25 calls for $1. And now I paid 0 premium to have the $15 calls of Barrick Gold. That means anything above $15. Remember, I'm sorry, it's a 10. Remember, it's a 10, 25 gold call spread. So I have a $15 spread that I'm buying for net $5. But I'm paying, the more important thing though is the long calls I have for net 5, I've got the $10 call. So right where Barrick is right now, for $5, I control that stock and I make everything going up until it hits 25, at which point I have to sell it. I can combine that if I'm willing to own Barrick stock, if I combine that by selling the $15 puts, which would put me into the stock for net $12.50, right? So if I also sold the $15 puts for $2.50, now I've only paid, I buy the spread for $5, I sell the puts for $2.50. Now I've bought the $10 calls for net $2.50. So I've only paid $12.50 net for Barrick. So my break even, because of the money I've put in, is still 15 because I sold the puts, right? So I still need to get to 15 to break even. But if no, I'm sorry, it wouldn't quite be that because I've got the 15 puts, so I forced to buy the stock at 15, but at $15 I make $2.50, so it'd be $125 less than 15. So my break even is $13.75, even though the stock is currently 15, and I've only paid net $2.50 for the $10 calls, so I can make up to $12.50 at 25, which is 5 times what I'm paying for the stock. So can you do that with a lump of gold? No. Well, then it's a no-brainer. Don't buy gold, buy Barrick. That's the way to go. All right. So that is our trade of the day. It's a good trade of the day. And again, it's a $10. You buy the 10s for $6.10. You sell the 25s for $1.10 or for $1 it's going to be. And then you sell the $15 puts for $2.50. And if it's a few pennies either way, it doesn't matter much. So the point is, though, you're into each spread, each $15 spread you're into for net $2.50. If Barrick goes below 15, you are forced to buy the Barrick stock for $15. And if you lose the $2.50, you would then be in for $17.50. So don't let both of those things happen. But you can always roll it also. That's another thing. When 2027s come out, you'll be able to roll it along. And again, it seems to be a tremendous bargain down here. And again, and also it's not really going to be worse than if gold drops 20% on you and you lose $400 an ounce doing that. So I would much rather have the stock. You can be more conservative and sell the $13 puts instead. You can be more conservative and sell the $20 calls instead. And if you did that combination, you're still picking up 160 plus 140, which is $3. Right? So you'd be taking $3 off the 620, and you've got a more conservative position, and you're in for net 3 on the I'm sorry, the 10-20 spread. On a $10 spread, you'd be in for net 3. I don't think that's necessary. I think we're low enough on Barrick that I'm not worried about the downside as much, so I would be more aggressive. But you can be less aggressive and do it like that, and you still can get a triple off it, which you're not going to get for your money for gold. Gold's not going to $6,000. How are you going to get a triple off of gold? But Barrick can easily triple your money. That's why I would much prefer to play it that way. All right, that's enough for me. And thank you everybody for coming. I appreciate it. Have a really good weekend, and I'll see you next week. All right, take care, everybody.